So today's discussion is about where is the income and growth on the Australian share market. And even though we're very late stage cycle and the bull market's been going now for 10 years and it's the longest, I think officially the longest bull market we've ever had in US history, it certainly hasn't been the strongest. And although valuations remain very high across the board, there are plenty of opportunities out there for genuine long-term investors. And so the way I've structured this particular presentation is I'm going to start with what I think are the most interesting high growth ideas, and then slowly work our way through to the higher dividend paying stocks. So whether it's growth or income stocks, this will give you good insight to the sorts of stocks I've been adding to the portfolios recently. Sorry, Soph. There we go. So it's an important quote, I think. Have opinions at extremes and wait for extreme moments. It's by a guy called Joe Rosenberg, former chief investment officer for Lowe's Corp. It's a fairly famous US company. The reason why it's important is because of this slide. And if you have a look at the right-hand side, it'll show you a very red line that shows essentially what has been the bull market or bubble, as this chart is telling you, in e-commerce or technology/internet stocks. And if you compare it to previous booms and bubbles throughout history, it's huge. So I think it's important to keep this in context. This is the sort of market environment that we are operating in. The market isn't cheap across the board, although ironically we're seeing passive funds continue to do really well, particularly ones with a technology focus, and particularly those in the US where the NASDAQ is a really large component of those funds. If you haven't owned technology stocks recently, then it's been very hard to keep up with the market. What was quite incredible, we had, I think it was the worst December since the Great Depression in terms of market performance, and we had the worst December quarter since the GFC. And yet it just, once the central banks decided they weren't going to increase interest rates anymore, in February, the market come flying back, but all the money was really focused on, and this was both in the US and in Australia, was focused on the half a dozen technology names. So if you haven't owned them, then it's been very hard to keep up, and we haven't really been owning them. We've got one or two little names, but that certainly hasn't been enough. If you look in the paper at the moment, we're starting to see people suggesting that there's an end, or at least a pause, to the downturn in Australian property prices, and I'm sure a lot of people will be very happy about that. But there's something that we haven't contended with yet, and I have no real prediction about what it's going to be like for property prices over the next 5 to 10 years. But I wouldn't be surprised, given how fast they've fallen more recently, is that they start to plateau, or we just get smaller falls over a much longer period now. The one thing that the RBA is really going to struggle to do, regardless of whether they lower interest rates or whether the prudential regulators decide to do away with the 7.25% cap on people's ability to pay, that's the interest rate that ANZ CEO Shane Elliott was saying last week. He wanted that level reduced so people could borrow more money. The problem is there's no Western country out there at the moment that has debt levels anywhere near what Australia has and would call those sustainable debt levels. The debt levels are about 25% lower in most cases, or even lower than that. And all those economies have quantitative easing as well, so it tells you even those debt levels aren't sustainable. And so Australia is almost on its own where those consumer debt levels is. And the problem that we're about to face is what these next three charts are showing us, is that dwelling approvals in Australia are about to fall off a cliff, or we're actually already seeing that, but it's getting worse. If we go to the next slide, and the slide after this one also shows that 1 in every 10 jobs in Australia is a construction job. And all these people have been very heavily, have had huge demand for their work, building apartment towers. And I live in a suburb in Sydney where you could almost rename it Meriton. There's that many new buildings getting unwrapped at the moment. And once they're built, the pipeline is just much, much smaller. We're seeing falls of 50 to 60% in apartment dwelling construction expected over the next few years. And so the question is, where are these people going to find work afterwards? You can see that the average, just on this particular chart, if you go back to, say, 2002 or around 2002, 2005, which is probably a bit more, a better example of what a long-term employment rate for this particular sector would be, there's quite a big fall there from the 9.5% currently down to around 7.5%. And that assumes that you just go through a fairly normal period if we actually had a period where things got really bad, then you would expect that number to come back down to 6.5 or 7%, but we're a long way from that yet at the moment. This is just showing the construction job ads and the construction employment, and you would expect job ads to be a leader of actual employment, and you can see how job ads have come right off. And this chart also shows on the left-hand side what I've been saying about how many jobs as a percentage in Australia actually come from construction, and it's very high. The funny thing is, well, funny is probably not the word for it, but as you would have thought in the last year or two, as property prices have been falling, and we've also seen the demand for investor loans basically collapse, you would expect household debt in Australia to be falling, and actually it hasn't been. It's been going up. We set a new record at the end of last year, and the fact is, what is at least what I think it's telling us is that people can't afford to reduce their debt. They've taken on so much debt for their homes that they just can't reduce those borrowings. And so what we're going to see now is that borrowings, also the repayments, are going to increase as a proportion of their wages. People just simply don't have the spare savings in Australia, where the savings ratio has absolutely collapsed to almost near zero. People just don't have those savings to be able to put to retire debt. And the fact is, people just cannot afford to reduce their debt, and that's a really, really nasty place to be. So again, this is the background. I'm not sitting here saying we're going to have imminent collapse in the economy. All I'm saying is that you need to take these factors into account when you look at individual businesses. And in our income portfolio, we've got about 14 to 15% in Australian banks, which is shared between Westpac and Commonwealth Bank. And we've seen horrible numbers coming out of National Australia Bank recently, and we saw a very ordinary report come out from Westpac today as well. Although a lot of the reason for the fall in Westpac's profits is the remediation claims coming out of the Hayne inquiry, which will be transitory. NAB's cut its dividend, Westpac hasn't, but we just simply cannot expect to have high capital growth from our banks and high growth in our economy when there's so much debt. We're really going to have to go through what I expect to be a fairly long, slow period of reducing that debt. And what the central bank is trying to do, and what the government really wants, is for that reduction in debt to be very slow over the next 5 or 10 years, rather than for it to be sort of a sensational decline, because that's when property prices will really fall, and we'll have a more American or European style price falls that we saw in 2008, 2009. But we're a long way from there at the moment. So, but I just think more on a valuation perspective, Australia's banks still, to me, don't look cheap vis-a-vis the European or US banks, which are returning lots of capital to shareholders, and their valuations are much, much lower than Australia, and they've already been through their housing bust, and we're only dealing with ours now. This chart here was only taken up to the 20th of February, but it's February was the biggest month for returns we've seen over the last 4 months by a long way. And you don't need to know the detail there, but what it's telling you is it hasn't been earnings growth, which is really what you want to see for driving market returns. It's pretty much all been just increases in valuations or increases in price to earnings multiples. So what that's told you, that since the central banks have put on the brake in terms of increasing interest rates, the way investors have responded is by putting more money into the most expensive stocks and just driving up valuations even further. And I would have already thought that the technology stocks in Australia, or the wax companies as they're famed, were already trading on exceptionally high valuations, and they've only increased since then. So if you're looking for a margin of safety, you're probably not going to find it in those stocks. This is a chart based on the US stock market, on the S&P 500, and it shows you the divergence between the performance of growth stocks and value stocks. And you don't need to be a detective to work out that the growth stocks is the one, the chart heading straight to the bottom. And you can see that the gap or the divergence between the two types of stocks has actually reached a new high, and it's greater now than it was during the tech boom in 1999. Now, the problem I have with this chart is that the stocks that, if you look at, that are the very low PE type stocks, low price to earnings ratio type stocks, in the States, you can actually buy some fairly good companies trading on lower than average market multiples. American Express would be a really good example, which is a very, very high quality business trading around 14, 15 times earnings versus a market multiple of around 17 or 18 times. But if we look at Australia, where I expect you to see something very similar, we don't really have those proportion of, I guess, older, slower growth companies trading in that lower market multiple group. So I actually find it very hard in Australia to make use of this chart. All I can say is it's just providing a bit of context for the market we're in, because if I look at something like Woolworths, which is quite defensive and is not growing very fast at all, and it's a small holding in our income portfolio, it's actually trading on around 22 times earnings. And that is not a cheap price for a company growing as slowly as what Woolworths is. And where I'd also point out that the Australian supermarket companies have the highest margins anywhere, I think, in the world still for a supermarket. And in a sense, if we're moving to more of an online or digital delivery business model for these businesses, then that's actually worse for margins. So you've got to question, when you're buying these companies, what sort of returns do you expect? And if Woolworths can do, say, a 5% dividend or roundabouts and 2 or 3% growth over time, then I think that would be perfectly fine for our income portfolio. But if you're expecting anything more than that, I think you're going to be disappointed. But if we can have some nice solid businesses in our income portfolio in particular that pay good dividend yields, then we can have some more faster growing companies at the smaller end of the portfolio, and that's how I expect we'll outperform the index over time. I've got this slide here. I've just got the same chart in, but I just want to raise a couple of other points. So that in the title it says AI, so that's artificial intelligence, passive and momentum funds fueling higher valuations. One of the ways that artificial intelligence is being used in the funds management industry is, for example, they'll run a software program over, say, management commentary after a quarterly or 6 monthly report, and they'll look for the number of positives in the report. And if they find, say, 70 or 80 positive words in there, then they'll buy the stock. And so it takes into no consideration the valuation of the stock. And that's why I say this artificial intelligence impact on the funds management industry or stock prices, and also the impact of passive and momentum funds, which have performed very well because they've owned a lot of the technology stocks, particularly in the US. You're seeing these trends just create what Charlie Munger would call a Lollapalooza effect, where they're all just feeding on each other and pushing stocks, particularly fast-growing stocks, all in one direction. So again, I'm just pointing this out for context because it talks about what we should expect from future returns, and our expectations should be modest, but also it tells us where are we going to find value. And on the right-hand side there, I put a couple of dot points, and from the heading in the title slide there, I said we must find value in what machines can't process. And 360 Capital is a stock that I'm sure a lot of you have heard me talk about before. It has hidden assets on the balance sheet, is transforming into a fund manager, and that's not something that can be easily picked up in a P&L or by artificial intelligence. So that's why I think it's a very cheap stock. I'll explain why to anyone who's heard me talk about it multiple times already since I've come back to the company. I apologise, but there's been some more good news on that front. So I just think it's an important stock for the portfolio, and one I think we're going to do well in. So unfortunately, going to hear me talk about it again. And again, Frontier Digital Ventures as well had some really fantastic quarterly report. I'll talk about that later, but again, it's a business that's very complicated in terms of its accounting. It has lots of joint ventures. It has 15 equity stakes in different businesses, and so it's the sort of thing, and it doesn't report profits in the true sense. So you can't just go and look at the P&L, see a nice chart of earnings per share growing over time. It's not the way that you work out the value for that stock. And again, it's also the sort of thing that artificial intelligence can't do. So that's where we have an edge as investors, and we need to be very careful about where we think we can have an edge. These are the sort of stocks where I believe we have it. And the other one is also just to have a long-term time horizon. I just want to repeat this. I do it in all our presentations because we often have a lot of new people come in, and I just think it's important for me to show you that there's been no change in our investment process. We still believe it works, and even though we're underperforming at the moment, it's because we're not prepared to take as much risk as the market. And we've seen how these big booms or potentially technology bubble, we've seen how they end in the past, and I have no doubt that the future will be exactly the same. And so this just provides us a bit of guideline to make sure we're not taking extra risks, that we're patient, and we're finding the types of businesses that are going to give us great returns over the next 5 years, and not take the risk of trying to buy into momentum for the next 12 months and then come out much worse for wear on the other side. So our process is very simple. What we really like to find is high quality businesses with long growth runways. It's particularly important in today's age to be on the right side of technology, because in the old days you used to be able to buy some companies that their profits were essentially in runoff, but they used to run off over a long period of time and you felt like you had a margin of safety buying those stocks. These days that margin of safety just ends very quickly. Once a business is on the wrong side of technology, people tend to be able to switch away from their services very quickly, and that rump of profits disappears almost overnight. High insider ownership is something that is very important to me, and you'll hear me talk about it over and over again. We want management in there working for us. We need them to be entrepreneurial, because we need businesses to be able to shift very quickly to competition these days, quicker than they ever have been in the past. And we need them thinking about the next 10 years and not just the next 12 months like most corporate or commercial CEOs do. And you can see I've just named a few stock tickers there that two at least we'll talk about today, but you'll see a very unusually high amount of insider ownership of the stocks we own in the portfolios. And as always, the bigger the discount to intrinsic value, the better. The other type of situations, which I'll put into a group called special situations, is companies where a new CEO has come in, can be a great change for the future of the business. Blackmores is a perfect example of that, and I'll talk about that in a little bit of detail in a moment. Recapitalised stocks where essentially the existing ownership base has given up and sold their stock for reasons not related to value. Don't have any of those in the portfolio at the moment, but we're always looking for them. A spin-off recently, Dulux is another one. We've done quite well out of these recently. Dulux, unfortunately, I only had in our test portfolio for our new fund, the ethical fund, which I'm sure you've heard about. So we've got a nice little start in there, but unfortunately no one's invested in it, so they don't get the benefit. But again, it just shows you these spin-off companies tend to do really, really well over time, and that's a trend that doesn't seem to be going anywhere. So it's a great, reliable statistic for our performance. And the last one there is hidden assets and 360 Capital, which again, I'll talk to shortly. So remember I said the way this presentation is structured, we're going to look at the fastest growing companies first, and then we'll work our way to the more dividend yield orientated stocks towards the end. So Ordinay, if you've been listening to our weekly podcast, Skin in the Game, which I do with our small cap manager, Alex Hughes, then you'll know all about Ordinay. But essentially, a very simplified way of looking at this company is that if you go into our little media room, for example, you'll see cords all over the place for the audio equipment. And basically what Ordinay do is put a little microchip into the design of audio equipment. And let's say it's Yamaha, so Yamaha will build a speaker with the chip in it, and then Ordinay has the software to be able to pick up those signals, and then whether you're listening to a presentation at an auditorium or it's just a speaker at home, you won't need those cords, and essentially you can manage the audio equipment that way. Now, this is a small business in the sense that it's only a market cap of $383 million, but it's been performing exceptionally well for our growth fund. Recently, unfortunately, we only had a small amount in it at the start, so it hasn't had as big an impact on the fund's returns as what we would have liked. But this is a very long-term holding for us. We have no intention of selling it, even though the valuation looks quite large. To give you a bit of a sense for just what this business could be over the next 5 to 10 years, it basically has what I think is almost next to no competition at the moment. The competition is completely falling away. The biggest competitor sells less than 20% of the amount of equipment, or another way to put it is its microchip essentially is installed in less than 20% of the volume of products being sold compared to Ordinay. It hasn't grown revenues in many years. Ordinay is flying. It's potentially targeting a market of $1 billion. Audio is $400 million of it. Its new stereo offering is another $400 million, and the $200 million remaining is the software, which only Ordinay can provide for its products. So in a sense, it's almost like it has a monopoly, but it's still a small growing business, and I wouldn't quite call it a monopoly just yet. Its current sales are only running at $30 million, but if you think about over time, if this business can have 60 or 70% of this $1 billion market, based on the sort of profit margins we would expect from a business like this, then I just think this is a wonderful business to own for the next decade. We've got 8% insider ownership, so it ticks all the boxes for a business we like. It looks expensive on the surface, but we think this is a business that, given enough time, will grow into its valuation and more. Frontier Digital Ventures is a company run by and founded by Sean Di Gregorio. He's ex-REA Group, and he's also better known in the investment community for moving to iProperty and fixing that up for some internet investors in Asia called Catcher Group. They were having real problems with iProperty, which owned a bunch of REA Group and car sales like companies across emerging Asia. He got in there, fixed it up, and actually sold the business back to REA Group. And so he took the money that he made from that and created Frontier Digital Ventures, which is, so the business has shareholdings, say from 25 to 30 or 40% in these fast growing but small businesses in frontier economies. And its biggest asset by far and away is Zameen, and it's the Pakistan version of REA Group. Now, I've owned stocks in this company since it IPO'd a couple of years ago, so personally I've been waiting a long time for this most recent result, but it finally came, and what we've been waiting for is Zameen finally had its first quarter of profitability at the EBITDA level. And if we have a look at the classifieds businesses in Australia and around the world that have met this point in the past, this is basically the absolute turning point for these businesses when they're self-sufficient. They don't need to raise cash. It's your last chance to get in these businesses before the share price tends to go exponential. Now, Zameen isn't listed. It's a private company. Now, Frontier owns 30% of this business, and at the moment on our numbers, you're actually able to buy Zameen at a discount and get the holdings in 14 other classifieds businesses for nothing, and there's $70 million of cash in the bank. So I think this is exceptional from a future growth perspective. I think it's exceptional from a valuation perspective, and only now has Frontier basically broken even. And once that happens, it's the first time most fund managers can really go to their investment committees and say, we found this business, it's at break even, now we can potentially invest in it, because most investment committees won't let a fund manager buy into a company if it's producing a loss. Insider ownership is at 21%, and it's actually much, much higher if you include Catcher Group, which have supported Sean through into this business. Zameen is still only very small. It produced $22 million of revenue last year, and in the first quarter of this year alone, it produced $10 million. It's a slightly different business to REA Group, which completely relies on advertising. 2/3 of Zameen revenue comes from clipping the ticket on property transactions, so it's more cyclical. But it's a different business that works across these frontier economies because people have very little trust in transacting with large amounts of money. So Zameen has become that company, so that's an excellent position to be in. And given how small this business is, I mean, we're talking maybe a revenue run rate at the moment of $40 million for a country with 195 million people in it, where if you have a look on the Zameen website, you'll find apartment buildings that look no different to they do in Australia. There's big cities with 11 million people in them, with lots of people with plenty of money, and also a lot of expats that live in London, and so places that so they earn pounds as currency, and they're able to spend a lot of money buying local properties back in Pakistan. 360 Capital, I won't talk about for too long, just because I've talked about so much in other webinars and podcasts. 360 Capital is a small property group. This is the historic share price performance, but this company is at a transitional point. It's now turning into a funds manager rather than just buying property outright. And we've had some exceptional news, and yet the share price has done absolutely nothing. And the reason I believe that's the case is because it's just off most people's radar. It's quite illiquid because Tony Pitt owns a quarter of the shares, and it's just for just about any, even for us, it was hard to get a decent stake in the business. At the moment, I think this is the largest position in our growth fund. So the fact that the growth fund actually kept up with the market last month, and the fact that our biggest positions are only early positions that have done absolutely nothing, and we think they're capable of returning multiples of your money over time, I think that just puts the portfolios in excellent position for the next 5 years. So don't worry about the underperformance recently. It's meaningless. It's about what we're going to be able to do over the next 5 years, and it's because of companies like 360 Capital and Frontier and Ordinay that I think we're going to do really well. And the good news for 360 Capital recently was it announced that it was going to launch 3 different property funds, where it would be a co-investor. So in a sense, it puts chicken feed into the funds. It gives people confidence that they've got their own money on the line. They raise money from other people, and then they charge fees for managing that money on different projects. And a couple of months ago, it said it was going to raise $25 million each from 3 different property funds. And we had an announcement just the other day that done a joint venture with another party who I think is an exceptional manager as well, who has an extraordinary track record of building and selling businesses. And they're looking to raise $250 million in a 50-50 joint venture into essentially funding businesses like NextDC, which has the databases of the cloud. So it's a fast-growing area. So if you just take a step back, at the moment, Tony Pitt has announced that he's going to potentially raise just for 360 Capital 75 plus another, so that's $225 million of funds that is going to be taking fees off. And I assume you're only going to launch these funds if you've already got the clients lined up. And at the moment, for the share price, you're paying absolutely zero for this funds management business that could potentially be managing either directly or indirectly around over $300 million in the next little while. And that says nothing about how much money they're going to raise in the future. So I think this is a pretty extraordinary opportunity, and I think you'll do well in this company even if the funds management business wasn't there. If the actual 360 Capital balance sheet is just a cash box at the moment, and even if it was just investing that money, I think you'll do well and buy it anyway. So the fact you're getting all this other stuff for free, and this is why I'm not too concerned about the Australian economy, because this doesn't really play a big part. And if the economy was to collapse today, then Tony Pitt would absolutely be rubbing his hands together for all the opportunities he could buy into. And actually, the most disappointing thing I heard out of Tony's mouth recently was that he thinks the actual property downturn in Australia, particularly in Sydney, will be quite shallow. And that's because he thinks there's only about 2 to 2.5 years of pipeline of extra apartments, if you like, that have been built. And he said after 2.5 years, that supply will be eaten up anyway, and we'll be moving on. So this one's been a bit more in the news. Blackmores, this is a company that traded around $220 a couple of years ago, and the share price is now just above $90 and trades at 22 times earnings. Blackmores is a vitamins and supplements company. It has extraordinary market positions in China, where the amount of money that the average Chinese person is spending on vitamins and supplements is absolutely tiny compared to not just anyone in Asia, but just tiny compared to just anywhere else in the Western world. So there's an absolutely enormous opportunity in China, and yet it trades on 22 times earnings, and the margins at the moment of this company are awful. It's about a 15% operating profit margin compared to Swiss, which we all see Nicole Kidman and Ricky Ponting on the TV advertising. Their profit margins is double that, 30%. Now, I don't expect Blackmores can get to 30% for a bunch of reasons, but it did produce a profit margin of 25% a couple of years ago, and I do think it can get much closer to that. So even if it just got the margin up to that, then this company would probably be worth at least 40 or maybe 50% more than what it is today on that particular issue alone. Marcus Blackmore, who is the son of the founder and has the big insider ownership there of 22%, he's been the chairman for a long time. He's been in the business for almost as long as I've been alive. And he's stepped in as interim CEO because the last CEO decided he wasn't the right man for the job and walked. And Marcus hasn't been happy with a number of issues within the business, and he's actually done a lot of interviews, including one with Alan Kohler here on our website. And he talks about the margin issue. He said the company's just far too fat at the moment and needs to lose a lot of staff. He said the company shot itself in the foot with the Daigous, which is the people in Australia who buy up a whole bunch of product and then take it to China and sell at a margin. And he said what they've done wrong is that they haven't supported those Daigous with new products and didn't realize just how much of the marketing that those Daigous were doing for the business in China. So looking to re-engage. And the other part of the equation, he said that we just haven't been producing enough new products, and that's a self-inflicted wound. So there's actually nothing wrong with this business. It's actually just been all self-inflicted, and that's absolutely what you want when you see a company going into a downturn, is that all the problems are fixable, and they absolutely are here. The balance sheet is absolutely fine, so it can make whatever investments it needs to make. And even on the current price, you're getting a dividend yield of 3.3%. So if I'm someone who's looking for a dividend and I'm looking for that dividend to grow over time, yes, okay, the banks might be paying, let's say, anywhere from 5 to 7% dividend yield at the moment. And bearing in mind, if we actually did have a proper housing downturn, those dividends will be coming down. Here's a company that I think can grow very fast over a long period of time, has excellent market positions, great tailwinds in the vitamin supplement market, and low share. I think it's only got 2% of the Chinese market. in a market that's going to grow just absolutely exceptionally quickly over the next 20 years, given that the average per capita income in China is very, very low, and you're getting a starting dividend yield of 3.3% for a vastly underperforming business. I don't mean that by share price, I just mean in terms of what it's capable of on a revenue and profit run rate, you're already getting a 3.3% dividend yield. So I think this is the sort of business that's that's the reason why it's in the growth and income portfolios, because I think it can do the rare thing and do both, pay a good income and grow profits. The next company is in both our growth and income portfolio. It's Clydesdale Bank. The share price has come down a long way from its recent highs. It currently trades at just 0.7 times book value. Clydesdale Bank is the sixth biggest bank in the UK. It has excellent management with a great track record of reducing costs. The company has recently acquired Virgin Money UK, and unfortunately when it came out, because the economy slowed a little bit in the UK and interest rates have come down around the world, including the UK, all of a sudden it's not making it enough money, or as much money as what investors thought they would when the company bought Virgin Money. And it can't, for reasons I won't go into, but it can't actually fix up the margins in some of the businesses in Virgin Money for at least 12 months. So when that happens, I expect profits will go up. But Clydesdale also has an excellent balance sheet, and I expect dividends to decrease dramatically from a fairly low dividend yield of about a couple of % at the moment. I think that's going to grow to 4 and 5% over the next 2 and 3 years. And in June or next month, the company will be coming out with its next 3-year plan, which will include, I'm sure, goals on all those points. So I think this is an exceptionally cheap business and an excellent way to diversify your Australian bank holdings. But I also think it's exceptionally cheap as well, regardless of the dividend. So it's holding both our growth and income portfolios. And it gives you some international diversification, which I think most Australian investors are in dire need of. Next company is Tabcorp. It's a wagering company, and now it's also a lotto company after it recently acquired Tats Group. Only 22% of lottery tickets are sold online, and yet Tabcorp owns the only major lottery license in Australia. And I expect that 22% to potentially go towards 70% or higher over the next decade. So this is a huge growth runway for this business. And at the moment, people are spending more and more on lotteries because recently Tabcorp or Tats has increased the odds on a number of its most important games, and we've seen these jackpots after jackpots. And there's a point where people actually get jackpot fatigue, believe it or not. But we're a long way from it at the moment, and more people have been willing to spend more chasing these much bigger jackpot amounts. And I'm sure you've seen on the TV, like getting into the tens of millions of dollars. Now it's just it's huge amounts of money on the line. And so as this thing goes digital, people spend more money on lotteries. So that's a big tailwind for the business. And in the wagering business, which I would expect to be more sensitive to the growth of the economy, there's actually been a change in the tax law, which now makes Tabcorp's wagering business much more competitive compared to a lot of the online rivals who have been taking market share over quite a long period now. So I think that's a couple of real tailwinds there for the business. It yields 4.3%. I don't expect huge growth from this business, but I expect enough growth to do at least 8% total return over time. And in this environment, for a very safe business and a nice fully franked dividend yield there, I think that's a really good stock idea for us. So that's the end of the Australian ideas that I thought I'd talk about today. Just for fun, for those of you who have any interest in investing in stocks overseas, a friend and ex-colleague of mine who I won't name, but he has a absolutely wonderful Twitter handle. He's called Hardcore Value. And if you're interested in following stocks, there's some wonderful Twitter handles that you should be following. They don't give up their personal name in a lot of cases, but I just know a big group of them who don't like to be publicly named. But so if you go to Hardcore Value, if you go to his tweet on 25th of February, he does an excellent presentation for Nintendo, which is about 40 odd slides long. It's absolutely terrific. It's easy to read. It's a wonderful piece of analysis. So if you are interested in overseas stocks, he talks about how there's new management at Nintendo, which is needed for a very, very long time, how it's now following the Disney model, which, funny enough, investors are all racing to buy into Disney stock at the moment. Now it's got a streaming service to compete with Netflix. Nintendo is also moving to gaming as a service, And most of us are now familiar with how valuable the software as a service business is. It's that recurring revenue, which is part of the reason why software stocks at the moment are potentially at least bubbly, if not in a bubble. And my friend also thinks Nintendo is at least, the value of the shares are valued at least 2 times, if not higher, than what the current valuation is. I also know the share price went up about 15 or 20% one day last week. So I just think if I was investing internationally, then I would definitely be having a look at this business because it's got so much going for it, and you'll see that for yourself in the presentation. So I hope you at least get some use out of that. So we've got Q&A coming up. I remember from the last webinar I did a few, it was probably 4 months ago now, someone asked about where they can get a list of the most shorted stocks in Australia. And if you just Google it, you'll find there's a website called Red Bull or the Bull, either one, that comes up. I think it's thebull.com.au actually, not Red Bull. And that I think publishes the greatest, the companies with the highest amount of shorts, most shorted stocks, the top list of 20 every week. So with that, we'll have a look at any questions you've submitted today.
So we currently don't have any questions. So if you do have a question, please feel free to submit it. But for the meantime, while you are doing that, do you want to chat a bit more about the ethical fund?
So people might be getting a bit sick of the ethical fund, but some of those stocks that I mentioned today are certainly in there, and I'm going to do another webinar next week and just go through some other stocks as examples as well. Even if you're not interested in the ethical fund, you might want to watch the webinar as well, because there'll be some many of the similar growth stocks as well. I mean, Blackmores will certainly be in there, and Frontier and Ordinay, but I'll talk about a couple of extra names as well. I mean, no one's sending any questions, so you're making it easy on me today. So we'll probably just leave it at that. As always, we've got our regular podcast. We record that Thursday mornings. I do that with Alex. So if you've got any questions for that, you can always send them into skininthegame@investsmart.com.au, and we'll pick up and answer those for you. As always, thank you very much for your support. What I would really appreciate more than anything is that if you're reading our monthlies and quarterlies, I'm putting quite a bit of effort into them compared to what's been put into them in the past. I'd really love you to share them with anyone that's looking for a trusted investor. I hope that's why you're with us, and I really would appreciate that, because we really do want to grow the business over time and bring on some more analysts and keep finding more ideas for your portfolios. Thanks very much.